says that its portfolio is now valued at $1.07 billion across 195 startups. The company also put out the top trends that emerged on its platform this year. Here's the list. Investor interest from global Indians as well as investors from outside Bangalore, Mumbai and Delhi has been increasing. Let's Venture added around 1,500 new investors this year. This amounts to a 23% growth over the last year. Global investors constituted close to 28% of the new additions, while investors from outside cities of Bangalore, Mumbai and Delhi constituted 21%. Angel commitments have doubled from $11,000 to $21,000 in 2019. Angel rounds are now averaging at close to $750,000. This is a market increase from an average of $200,000 in the early years of Let's Venture. Let's Venture now has 22 syndicates on the platform, out of which 12 were launched this year alone. Syndicate leads are second-generation family businesses, successful entrepreneurs and marquee angel investors with remarkable exits. Some of Let's Venture's syndicates are led by Anupam Mittal, Pallav Pandey, Vivek Khare, Mohit Satyanand Sensai and India Quotient. Let's Venture says the ease of organizing investments has been significantly impacted by SEBI's Angel AIF. AIF being a registered SEBI, Let's Venture being a registered SEBI AIF, it saw more than one investor joining per day, taking the accredited investors sign-ups to 470 with a committed AUM of $19 million so far. The Angel AIF allows founders to have a single cap table entry, and founders and investors are increasingly using this vehicle to structure their investments in startups. In 2019, 34 of Let's Venture startups raised follow-on rounds in terms of a sector-wise split in deals. Let's Venture saw maximum deals done in healthcare, F&B, AI, education and retail.
Thank you, Mugdha, for that. Now, just months after conversational AI software developer Uniphore secured a $51 million fund in a Series C round, the company has firmed up its investment plans on the back of a five-fold growth projection. In an exclusive chat with my colleague Jude Sanith, Uniphore's co-founder and CEO Umesh Sachdev details these plans and explains why the US market could be crucial to the startup's future growth. Take a listen.
We raised $51 million this year in July, right? And that was at the back of us registering a 300% year-on-year growth last year, which was, great for us, but also rare in the B2B segment. We hear of these kind of growth rates in the B2C space. The reason we were able to raise such a large round, and at that time, it was one of the largest round in our peer group in the conversational AI industry that Uniphore is in, was that not only was last year a 300% growth, but with this year at the higher revenue base, we were again projecting a 300% growth. So the promise of a very high growth company for the next few years was what attracted these investors. Happy to say 5 months in, we are not only on track, but we might end up doing a 400 to 500% growth this year. So we are accelerating as we are growing bigger, right? And for people to recognize the revenue base is increasing every year. So, the percentage growth rates are now happening at a higher base. Three things which are driving this, right? Like you said, first, our geographic expansion. 3 years ago, we went to Asia Pacific. My co-founder in 2017 moved to Singapore, and now we're present in 9 countries in the Asia region. India's home market for us. Last year, I moved to Silicon Valley to expand into our US operation, and that's been fabulous for us. By the end of this year, US will end up being about 60% of our overall revenue, with Asia being about 40% of which India is a part of. We are now so bullish on the growth that we believe that next year we should press the pedal even more. And so getting into geographies that we are not currently present in, including Europe, Latin America and Canada, and Australia and New Zealand. So there's a geographic expansion lever that will continue to get pulled over the next 2 to 3 years. And there's enough for us to do around the world. One of the biggest investments I personally made in terms of both time and money after the funding was building out a very solid team all around, right? So we grew from about 120 people around the time the funding was happening to slightly over 200 people now, projected to be close to 300 by March. So you see how fast this is ramping up. And I started focusing on top down. I first brought in my leadership team, top executives, both in Silicon Valley, in India and in Asia. These are people from the industry, veterans at what they do. And so now we are building teams around them and just focusing on building a very strong, innovative and winning culture, which is driving all of this growth. We are no more satisfied with 100 to 100% type growth. We want to conquer the world. We want to be the #1 company in our space. And it's a massive market. It's a $350 billion market.
Umesh, so I have to ask you, given there's so much promise of growth that you expect going forward, and given that the US is already contributing 60% to all of this, and you're focusing there as well by way of the Silicon Valley trips, I have to ask you, what is the focus right now in terms of geography? Are we looking at US? Are we looking at APAC? Are we looking at Europe? Which part exactly will you be focusing on, and which exactly is your cash cow going forward?
Got you. So let's look at the big picture. The big picture is out of the $350 billion available market that we have globally, 50% of it, which is roughly about 170 billion, is North America. And the remaining 50 is rest of the world put together, which includes Europe, Asia Pacific, etc. Now, strategically for us to be #1 or #2 in our industry, we have to be #1 or #2 in the US, right? That has to happen, which is why I had to relocate myself to Palo Alto, to our new headquarters in Silicon Valley, and that's absolutely getting a lot of attention from the leadership team. That said, because of we being an Indian company first, Asia being sort of almost our home market, even before our other competitors move out of US and come to Asia, we want to make sure we have enough market share and we own this market. So as much as we are investing in the US, we are continuing to run extremely fast and making sure we have coverage all across Asia and India. Europe is a big market that we haven't gone into. And just, first it was 100% growth rate, then it became 300% growth rate. This year could be a 500% growth rate. Also, now that we raised 51 million, given the momentum, there is enough and more interest or more capital being available to the company in the future. So at this point, our mindset is just hyper growth. So we are saying, why leave out Europe? Why leave out Canada? Why leave out Australia and New Zealand? So US has to be, we have to make sure we are #1 or #2 in the US. It will continue to get a lot of time and investment, making sure we protect Asia and India as our home geographies and be the #1 here, and then make sure that in the next 2 years we have coverage in the markets that we are not yet present in. This is my definition of global domination.
Given that we're seeing a consumption slowdown, I know it's probably only for the moment in India, but given the fact that there are signs of a slowdown or recession happening geographically across the world as well, what kind of challenges will startups see in this space, including yours, given the fact that you are servicing these markets, and we are in the throes of what is likely to be a sustained slowdown? What kind of an impact will that have on business really? Because you talk about growth on one hand, and yet the economic factors seem to suggest a different story. What kind of challenges do you think the startups, including yours, will face?
Got you. So first, the big picture, our promise to an enterprise is, because of automation, is dramatically increase their efficiency, right? It's about net savings from their current operation, allowing them to do a lot more with less. That's why we do AI and automation, right? So therefore, if you think about it, as economies start to slow down, our kind of software applications will be more in vogue, because we will allow enterprises to survive at a lower cost base than they're currently operating at. So from that perspective, we are well positioned now or in the future in terms of our positioning to these enterprise customers. But that said, what we are observing, given that we have the vantage point of now being in 14 different countries, yes, India is seeing a slowdown, and we hope that it's not for too long. But the US data signs for the last 2 quarters have been very mixed. If you look at its historically low interest rates in the US, historically low inflation, the unemployment rate is again historically low. The retail sales in the holiday season have been record high, especially driven by online. Physical stores have not seen as much growth as last year's. So overall, if you look at it, yes, there's talk of, hey, it's been more than 10 years, so there's a cycle effect. But the data is suggesting that there's nothing that could be pointing out to an impending slowdown in the US economy. So the sense that I have, and some of the CEOs I've spoken to, is that we could see probably no slowdown all across 2020 in US. India has a domestic challenge, which is, I think, self-inflicted in some ways, and hopefully that will be short-lived in a couple of quarters. Most people here that I met this week, most CEOs of our customer organizations, believe that we are 2 quarters away from a rebound, and that will be positive. But fundamentally, from a US perspective, we are seeing nothing wrong.
Alibaba Cloud is bringing to India new database products. Which business segments does the company plan to target? We find out in just a bit. This is Startup Street.